Welcome to our deep dive on investing under high inflation. First, we will frame the problem. Inflation erodes purchasing power and shakes confidence in traditional investments. Next, we will lay out the evidence for why consistent investing, especially through diversified equities, historically outpaces inflation over long horizons. Then, we will compare alternative assets like real estate, gold, and crypto, and discuss their roles and risks. After that, we will translate ideas into an actionable plan using dollar-cost averaging and rebalancing. Finally, we will close with key takeaways and a couple of quick quizzes to test your understanding. Here is our roadmap. First, we will clarify how inflation impacts assets and investor psychology. Next, we will show why market timing is statistically harmful. Then, we will explain equities as a practical long-term hedge and discuss alternative assets with caution. Afterward, we will build a step-by-step plan using dollar-cost averaging and rebalancing, and we will close with costs, taxes, 2 short quizzes, and key takeaways. Before we proceed, a disclaimer is necessary. This video is educational and does not constitute financial, legal, or tax advice. Everyone's situation is different, and you should consult a licensed fiduciary advisor who understands your goals, risk tolerances, and constraints. Investing involves risk, including possible loss of principal. Past performance does not guarantee future results. Moreover, examples and funds mentioned are illustrative and not endorsements. Let us begin by defining the problem. Inflation reduces purchasing power, meaning the same dollar buys less over time. Consequently, fixed income like long-duration bonds may underperform in real terms when inflation is elevated. Cash hoarding can feel safe, but it guarantees erosion. Therefore, we need assets that can adjust prices, grow earnings, and potentially outpace inflation over decades. This leads us to equities and a diversified, rules-based approach. Market timing is alluring, but costly. Historically, a small number of the best days account for a large portion of long-term returns, and those days often occur near the worst days. Because rebounds are swift and unpredictable, waiting on the sidelines can lead to missing substantial gains. Additionally, the compounding you forego by not being invested can never be recovered. Therefore, adopting a consistent, rules-based investment schedule rather than relying on hunches is the statistically superior approach. This flow illustrates dollar-cost averaging. Starting from your income, you decide a fixed percentage to invest regularly. The automation directs contributions into diversified, low-cost index funds each month. When markets are up, your fixed contribution buys fewer shares. When markets are down, it buys more. Over time, dividends are reinvested and compounding accelerates growth. By repeating this loop for decades, you align with long-term market appreciation instead of short-term predictions. Equities provide a practical inflation hedge because companies can pass higher input costs to customers, preserving margins over time. Rather than stock picking, using diversified, low-cost index funds allows you to capture the market's average return with minimal friction. Additionally, longer holding periods reduce the likelihood of negative outcomes and minimize regret. Just as returns compound, so do fees, so it is crucial to keep expense ratios low to retain more of your gains. Here we compare major asset categories. Equities and broad index funds offer the strongest long-term real return potential. Real estate and REITs may track inflation through rents, but are influenced by local market cycles and interest rates. Gold preserves value over centuries, yet is volatile over standard investing lifetimes, making it unreliable as a sole hedge. Cash offers stability and liquidity, but loses purchasing power during inflation. Short-duration bonds mitigate interest rate risk relative to long-duration bonds. Finally, cryptocurrencies currently behave like speculative growth assets rather than stable inflation hedges. This pie chart shows an illustrative allocation blending growth and resilience. The largest component is global equities at 70%, capturing worldwide growth. Bonds at 20% provide ballast, preferably short to intermediate high quality to manage rate risk. A 5% allocation to REITs adds real asset exposure. 3% commodities or gold offers diversification benefits in certain inflation regimes. A 2% cash buffer supports liquidity needs. This is an example, not a prescription. Tailor your mix to risk tolerance and goals. Rebalancing maintains your intended risk profile. First, Define target weights and tolerance bands, for example, plus or minus 5%. Next, use new contributions and dividends to nudge allocations toward targets, minimizing taxes and trading costs. If allocations breach your bands, then sell overweight assets and buy underweight ones to restore balance. Finally, execute this on a consistent cadence, such as annually, to keep behavior disciplined and to avoid reacting emotionally to short-term moves. To turn ideas into action, first define your time horizon, goals, and risk capacity in a short written policy. Maintain a separate emergency fund of 3 to 6 months of expenses. Automate paycheck contributions to enforce dollar-cost averaging. Select low-cost, broad index funds to capture global equity returns, and prefer short to intermediate high-quality bonds in uncertain rate environments. Rebalance on a schedule with tolerance bands and avoid frequent changes. Optimize taxes through appropriate account selection and asset placement. Finally, evaluate progress annually rather than daily to reduce noise and stress. This table highlights that expense ratios vary and compound over time. Lower fees help you keep more of your returns. The funds shown are common examples, not endorsements, and alternatives with similar exposure exist across providers. Evaluate costs, liquidity, tracking error, and tax efficiency before choosing. Quiz time. Which approach is most likely to build wealth under high inflation over a 20-plus year horizon? Option A. Holding cash until a perfect market crash arrives. Option B. Consistent dollar-cost averaging into diversified, low-cost equity index funds. Option C. Concentrating entirely in a single commodity like gold. Option D. Rotating rapidly between assets based on headlines. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is consistent dollar-cost averaging into diversified, low-cost equity index funds. This approach captures long-term equity growth, minimizes the risk of missing sharp rebounds, and harnesses compounding. It also reduces behavioral errors that arise from attempting to time markets. Second quiz. Which statement best reflects gold and crypto in an inflationary portfolio? Option A. Both are stable, guaranteed inflation hedges. Option B. Gold is always the best asset over any 10-year span. Option C. Crypto is currently a speculative growth asset, while gold can diversify but remains volatile. Option D. Neither should ever be owned under any circumstances. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct statement is that crypto is currently a speculative growth asset, and gold can provide diversification but is volatile. Neither is a guaranteed inflation hedge over typical investing horizons, so they should be used carefully and not as all-in solutions. This timeline emphasizes consistency through cycles. In years 1 to 5, you build the habit. In years 6 to 10, you continue contributions through a bear market and the subsequent rebound. In years 11 to 15, dividends grow and are reinvested. In years 16 to 20, compounding becomes more visible and milestones are reached. The key message is to continue the plan across market conditions. These are the key takeaways. Inflation hurts idle cash. Productive assets are essential. Market timing is unreliable. Automation helps enforce discipline. Equities are historically the strongest long-term hedge. Diversification reduces single asset risk. Costs matter, so keep fees low and rebalance methodically. Finally, patience and a multi-decade perspective are crucial. To conclude, create a simple written policy to reduce guesswork. Automate contributions and reinvest dividends to harness compounding. Blend growth assets like global equities with ballast from short-duration bonds. Add small diversifiers thoughtfully, such as REITs and commodities. Review annually. Rebalance within set bands. And continuously minimize costs. Thanks for watching. If you found value here, please like the video, share it with someone navigating inflation, and subscribe for more evidence-based investing content. Finally, post your questions or your own strategy in the comments so we can learn together.